Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. We're getting very conflicting news reports on the economy in the last week or so. I mean, on Friday, today's the early Sunday release, right? So on Friday, you have President Trump coming out and putting this out. Fed should move to quantitative easing. This is a screenshot sent to me from my friend Greg Vanarino, who was just going berserk over this, as he should. This is pretty frightening that, if the economy was doing so great, why in the world is the president of the United States asking for more money printing? Is pretty unreal. And to help sort this out and see what's going on, what do they see that we're not seeing if the economy is so great, is John Rubino from DollarCollapse.com. John Rubino, thanks for joining us today on USAWatchdog.com.
Hey, Greg. Yeah, it seems like every time we talk, the world has gotten a little more interesting, but not in a good way.
Well, not in a good way. Listen, I want to say to people, I like Donald Trump. We'd be in a full-blown recession without him, without the rate cutting and the oil drilling and opening up all this Anwar and bringing back all this cash repatriation of funds. We would be in a full-blown depression. If Hillary would have taken over, she'd have sold Alaska and Hawaii, except for one island for Obama. And who knows what crazy stuff that maybe we'd be in FEMA camps. I don't know. I digress. What's going on with what are they seeing? Where all of a sudden, and also Larry Kudlow a week ago or so said we should have an immediate half-a-point rate cut from the Fed. So what's going on? What are they saying? What do they see that we don't see?
Well, all these cross currents that we're seeing now illustrate the box that the Fed and the other big central banks are in. Starting in early 2018, at least in the U.S., the economy started to look like a peak of the cycle economy. In other words, 4% unemployment, inflation starting to pick up. So the Fed started tightening. It was the only major central bank that tightened. And it got, 2 percentage points up on the Fed funds rate, which is nowhere near enough historically to give them ammo to fight the next recession. And the financial markets freaked out. We went from being at all-time highs in the U.S. stock market to a kind of a flash crash, down 20% in 2 months towards the end of the year. And so that told the Fed and the other central banks that they can never tighten again. This is it for this cycle and maybe for the entire remaining time of today's financial system for higher interest rates. So they immediately announced that, never mind about those 4 rate hikes that we're going to have in 2019, we aren't going to do anything. And if we do anything, it'll be in the opposite direction. We'll cut interest rates, we'll start a new round of QE, et cetera, et cetera. And the stock market went right back up to record levels, which kind of took away the rationale for easing. But at the same time, you've got as you said, you've got the president coming out and saying, oh, we need more rate cuts and we need more QE. And Trump is naming rate cut advocates to the Federal Reserve Board now. And the last guy he named was Herman Cain, or he nominated Herman Cain, who was, last time we saw, the head of the Domino's pizza chain.
Well, he also was with the Kansas City Fed. He was with the Kansas City Fed for 4 years. So he is a banker. He's a real guy. He also is a big gold guy, supposedly.
Yeah, well, the end part of this story is how good all this is for gold. But the middle part of the story is that the world's central banks, including the Fed, are probably going to ease next time they do anything. The next thing out of the Fed will be a rate cut. And the next thing regarding the Fed's balance sheet will be an increase rather than a decrease. In other words, they'll buy assets for newly created currency as a way of increasing the global money supply. And think about what that means. We're at, as you said, 3% or so in unemployment right now. We've got inflation starting to tick up, especially in wage inflation, because the labor markets are tightening in the U.S. And we're going to go preemptively to monetary ease in that kind of an environment. That's really new. A lot of this stuff is new, but this is very, very new. You normally don't do this. If you're a central bank, you wait until you see an equities bear market and a slowdown in the economy that gets people being laid off and things like that before you start aggressively easing. But apparently we're going to do it before that stuff starts to happen. So who knows what the impact of that will be, but if it works the way they want it to work, presumably more people get hired, wage inflation picks up, and we got real inflation in the 3, 4, 5% range before you know it.
Rickard said that the Fed wants inflation. They want inflation, which is kind of weird. You hear all this Fed fighting inflation, Fed fighting inflation, Fed fighting inflation, and all of a sudden, the consensus is the Fed wants inflation.
Well, yeah, the Fed's real job is to maintain the value of the currency. In other words, if the Fed was doing its job perfectly, there would be zero inflation. The dollar would be worth exactly the same next year as this year, and 10 years from now as this year. That's what a fully functioning, well-run Fed would give us. In other words, we wouldn't have to think about the value of the dollar. It would be like minutes and yards and years. It would be units of measurement that mean the same thing from one time period to the next. And that's how you get a really efficient capitalist system, because then people can project into the future when they're deciding whether to build a new factory or not. They know what the dollars they'll get will be worth. But because we keep taking on more and more debt every year, which requires more and more new currency to cover the cost of that debt, we've had to settle for a target of 2% inflation. And now that's not good enough. So we're going to have to go to 3 or 4 or 5% inflation. We might try to hide it by changing the definition of inflation. And you could make the case that we're already doing that by excluding financial assets from our measurement of inflation, right? If you put stocks and bonds and trophy real estate back into the consumer price index, it would be running at 3% now. So it could be that they'll play more tricks like that to avoid having to admit that we have 4% or 5% inflation. But they need, like you said, they need that 5% or so inflation in order to keep debt to GDP from rising from here on out. In other words, they need the economy to grow fast in nominal terms to soak up all that new debt that's coming out. And if they can't do that, if debt continues to grow faster than the economy collapses at some point under all that debt. And see, that's the box that they're in now. They would like zero inflation or 2% inflation at most, but they can't have that anymore. So they got to figure out how to generate higher inflation without freaking out the markets. So they're going to have to lie about it somehow. So, it's interesting from a financial and economic theoretical standpoint, what they're trying to do. But it's catastrophic for the real world, because this can't end well. It's going to end in some kind of a catastrophe financially. But it's what they feel like they have to do, and it's what they will do. So this is coming. This isn't even a conjecture anymore. This is a real thing that's coming our way shortly.
You're talking real thing in terms of much higher inflation. John Williams at shadowstats.com says, well, if you do the inflation the way it was done in 1980 by the Bureau of Labor Statistics, and you have steak as steak and not tofu, he says that we're running at about 10%.
Yeah, he's on the aggressive side of the people who are analyzing alternative inflation measures, but pretty much everybody who tries to come up with a better measure ends up with a higher number.
Yeah. Well, he says that if you go from the 1990 metrics that the BLS was using, it's around 6 or 7%, which, okay, it's still a lot higher than their target of 2%.
Oh, Greg, if we were actually reporting 6% inflation now, the world would be in crisis, because no financial asset makes any sense today in a world where the dollar is losing value at 6% a year. I mean, would you buy a government bond that yields 2%? If that meant you were going to lose 4% in real terms every year on that bond? The answer for most people is no, and so you would get a crisis in the financial markets, comparable to what we had in the 1970s. Inflation hit 4 or 5%, and things started to spin out of control back then. And we were in pretty good financial shape back then compared to now.
Yeah, we were a creditor nation, actually.
Yeah, and we got ourselves out of that crisis by raising interest rates to 18 to 20%, depending on the instrument. Could you imagine if we did that now? All the adjustable rate debt, what would happen to it? We would have bankruptcies everywhere you look. The whole system would collapse. So we don't have that weapon anymore.
I have friends that are buying a house, and they're like, I get 3.8% for 30-year money. I said, he says, well, what do you think is going to happen? I said, let's just say interest rates go to 6%. And on a chart, that's about the average for, I don't know, 20, 50, whatever. 6, 7, 6%. Let's say 6%. What do you think would happen to real estate? Oh, man, it would crash. 6%.
Yes. Yeah. New mortgages were 7 or 8% because the 10-year treasury was 6%. Nobody could buy houses at today's prices. It would make no sense because you've basically doubled the cost of the house for a lot of people. But your friends who took out a 30-year mortgage at 3 and change right now would be in pretty good shape in some ways. Because, yeah, maybe the value of their house would be falling, but they borrowed at really cheap rates. So
Yeah, but then
they at least got cheap money out of it. And if they're going to live in the house for that full 30 years, they didn't do as badly as somebody who, for instance, took out an ARM, an adjustable rate mortgage.
yeah, but their 3.8% loan is on let's say it's on a $500,000 house, and now your $500,000 house is worth $250.
Yeah.
Wow. I mean, I'd rather pay 8% on $250 than 4% on $500.
Well, see, the other thing about real estate is that it's kind of ambiguous in this scenario because it's a real asset.
Yeah.
Which means if the value of the dollar goes down, and that's the reason interest rates are going up, then real estate prices might go up commensurate with the drop in the dollar. That's what happened in the 1970s. Housing was a pretty good investment, even though the dollar was dropping, and interest rates were going up because house prices went up along with inflation. So it's possible, it's conceivable if your friends chose well. In other words, if they didn't buy a San Francisco condo or something where there's a bubble, that they do okay, just because real assets will tend to go up in an inflationary environment, even if interest rates go up. And see, that's what makes this such an interesting intellectual challenge, because you've got secondary effects and tertiary effects to rising inflation that aren't always intuitive. Sometimes it's not what you would think, but it actually does happen in these environments. Like stock prices can go way up in hyperinflation. For instance, Argentina and Venezuela, just lately, they had currency crises, but their stock markets went up a lot. Not enough to cover the inflation that happened, but if you look at a chart of Venezuela's stock market, it's spectacular. Same thing with Zimbabwe. Their stock market was the best performing stock market during their hyperinflation. But it still didn't save you. The currency that your stocks were denominated in went down even faster. So, there's a lot to think about. And one way to simplify this process is to look what always goes up in currency terms in times like this, and that is, well, farmland most of the time, and gold and silver every single time. Precious metals just tend to do well in times of currency turmoil. So the simple explanation, or the simple alternative to really trying to think through all of this, is just to buy some gold and silver coins and assume they will do okay, and that's the bedrock of your financial life, and that's going to hold up, and you will have capital at the end of the process. So that's the thing you pretty much have to do. The rest of this stuff is interesting and potentially really profitable, but it's more ambiguous. It's not as clear cut as just buy precious metals.
Well, with the president, what do you think he sees? And he's not only his and Larry Kudlow said the president agrees with me. We should have a 0.5 point rate cut now. So then now he's out on Friday morning saying we need to buy some stuff. We need to have QE. We need some money coming out. So what is he seeing in the economy?
It's easy to know what he's seeing. He sees an election coming in less than a year. And
actually, I want him to win. I mean, I don't want somebody like Cory Booker or Kamala Harris. I mean, these people are, or one of the 44 senators that voted to kill babies outside the womb, or one of the senators like Beto, who wants to open borders, and also he wants a socialist system and everybody in the world to come in. We'd implode. I mean, these are nutty time people. These are people chanting cop killing, hating, slogans from a cop killer that fled to presidential candidates, chanting slogans from a cop killer that fled to Cuba. Well, so, the choice is like... Anyway, go ahead.
This is the conflict in modern politics right now, and it has been for quite a while, is that if you want your guy to win, and he's the incumbent, then easy money makes that more likely because it creates a strong economy in the short run heading into the election. So what we've seen time and time again, since we went off the gold standard, at least in the 1970s, is every time there's an election, and remember in the US, there's always an election coming up, the pressure is on the government to ease. In other words, we need extremely easy money to guarantee that the incumbents in power stay in power. So of course, you get easier money than you would get otherwise if they were just looking at what was best for the economy.
And everybody does this. Democrat,
Everybody
Republican,
does.
everybody does it.
Yeah.
It's universal. Okay, go ahead.
So it's no surprise Trump is doing this, only Trump does stuff in public that previous politicians did behind closed doors. Ronald Reagan actually called Paul Volcker in and complained to him about higher interest rates. But we don't know that. We never see that, an account of that conversation or anything, because they did it in the Oval Office with nobody else watching. Trump, on the other hand, comes out and stands before cameras and jawbones the chairman of the Fed.
And says he's killing the economy, which, according to John Williams, that's correct. He was absolutely right that he was raising into weakness. Jim Rickards brought that up. It was the first time they've been raising into weakness. So yeah. So and the effect of this on gold and silver is going to moonshot it, isn't it?
Well, in theory, yes. According to the textbooks and according to common sense, you would say that gold and silver will rocket once central banks start easing again, because easing means creating a lot of new money and tossing it out there one way or another. They'll give it to the banks, or they'll put loan guarantees on a bunch of things, or they'll buy a bunch of assets from other people. They'll do something that puts money in the hands of private sector entities. Although calling the big banks private sector entities is a subject for another debate. But that money flows into things then. And the last time around, it flowed mostly into stocks and bonds. But I think this time around, with stocks at record high valuations, bonds having had a 20-some year bull market, and gold and silver being down from where they were at their peaks, a lot of that money will flow into precious metals. Just because, let's say you're one of the 1%, you've got $20 million in cash sitting around, you wonder what to do with it. Actually, that could describe you, Greg. So let's talk about you. You've got $20 million.
That doesn't describe me, man. I'm gutting it out, man. I'm getting donations, and all this, the weight of this in the background, all the attacks and all the, you run a website. I mean, it's like you got to work it. I mean, I'm the guy that dumps the trash can, and I'm the guy that interviews you, and I'm the guy that does the editing.
Yeah. We hear you. We hear you. You're not too rich.
I'm not too rich. I mean, I drive a Chevy. I got a Chevy. I got a nice Chevy. But
okay,
you know what I'm saying. Hey, go
for
ahead.
the purposes of our example, though, let's say you got $10 million sitting around, and you need to know what to do with it in a world that looks increasingly uncertain. And you can't just dump it into a Swiss bank anymore because they're watching that. Bonds are way up. They don't yield much of anything. Stocks are way up. And if you just, you ask your financial advisors what stock prices mean in today's world, they might come back and say, wow, wildly over, way too expensive. They're like they were in 2000 and 1929. And it's a risky proposition to put all your money in equities at this point.
What's cheap?
So what is cheap? Gold and silver. What's down and what is cheap relative to the fundamentals. In other words, it's not just the price of gold and silver. It's how much gold and silver exists relative to how much paper wealth exists in the world. And the amount of gold and silver that we're bringing out of the ground is growing at maybe 1 or 2% a year. In other words, the total supply of gold and silver is growing at that rate. But the amount of paper wealth in the world is growing exponentially. So that means the gap between the price of gold where it should be relative to the amount of paper and the amount of paper is widening year after year after year. So, for instance, Jim Rickards, who you mentioned a minute ago, who's a must-read in this world. He's one of the guys that I go to for insights on this stuff. He says if you run the numbers, you equate the amount of gold that's out there with the amount of paper that's out there and try to come up with a price that would allow us to go back to gold-backed currencies, you get $10,000 an ounce for gold. Now, even if he's wildly over optimistic from a gold point of view, and we only go to $5,000 an ounce, that's still a phenomenal place to put your money in times like this.
Maybe he's wildly underperforming. I did an interview with him, and out of the blue, I didn't even ask him, where do you think gold could go? Out of the blue, he starts talking up at this 10,000, and you back it by X amount, and then you look at the amount of money, and then, unless you want to back it by 70%, you want to back it by X, you want to back it by Y. He said, you can get to 40,000, you can get to 40,000 an ounce, and I'm just sitting there, I didn't even ask about that. Yeah, why is he putting that out now? Because I think the people in the background, they just raised the tier one asset, right? I want you to get your thoughts on that. Some people are like, Other people like Catherine Austin Fitts, who's not really a gold, she's a very brilliant woman. But she's like, that's a big change. That's a material change. Tier one asset, 100%. That's a big deal. Going forward, that's a big deal. What do you think? Are you in the camp, or this is a big deal?
Well, I'm in the, I'm not an expert on this stuff, so I'll listen to the people I trust. And the people I trust seem to think it's a big deal. Basically, what has happened is they've made gold a more attractive asset.
Yes, they did.
Banks to hold. And you've seen a lot of central bank buying in the last few years, whereas they were selling gold before, but they've been buying it lately. And that's part of the reason, I think, that gold is moving back into the center of the global financial system. So that may not be the determining factor in what happens to gold prices going forward, but it's a good thing. It's one more source of buying. If the big banks feel like they need to own more gold, in addition to the already pretty aggressive buying by China and Russia and India, and a few other smaller players in the world, like I think it's Turkmenistan, just increased their gold backing of their currency dramatically, and Turkey is buying a lot of gold. So you're seeing a lot of gold buying out there other than investment demand. And then see when the investment demand kicks in, when people like you with your $10 million decide what to do with their gold or with their money, and they decide that 5 or 10% of that is going to go into precious metals, then you get the rip-roaring bull market. I think it was Jim Rickards who last interview I saw was saying, we'll have $100 up days in gold and $10 up days in silver. And
well, he said it because he said he was not of the mind. He says, yes, the tier one asset thing is good, no question. Kind of like what you said. But he said what the Fed is doing is what's going to drive gold. And then you have Donald Trump with, hello, we need more QE. This is, come on, this is CNBC, man. This is Squawk Box. Hello, we need. That's.
Well, so you add it all up. You got central banks buying gold, central banks aggressively easing by pumping a lot more money out into the system, and you've got people with cash balances building up, wondering what to do with the cash and choosing gold. That's the environment of 2 years from now. So, in this world, you can't make any kind of really definite predictions about anything because so much of what we're doing is uncharted territory. It's never been done before, so you can't for sure know how it turns out.
I agree.
But it seems like a good bet. It seems like intuitively that's a great world for precious metals, and precious metals being very simple to buy and own are kind of not only the maybe the best way to preserve capital, but the most restful way to do it too. It's just not hard to do compared to rental properties.
You got to make sure people don't move out in the middle of the night and steal all the copper plumbing out of your house. And you wrote a piece about where the stock market is going, and you're talking about a top. This is you said this is what the stock market looks like in 3 charts. And if we could just go over that real quick, this is chart number 1. I'm going to go full screen on me with this. What is this?
All right, this is a chart that shows the blue line going up is wages. So basically, that's a measure of wage inflation out there and what companies have to pay their workers. The lower chart, or the lower line there, is basically a measure of overall inflation. So wages are going up faster than the prices of most other things, which is great for workers. That's what you want. You want your paycheck to get bigger than your grocery bill, year after year. So finally, workers are getting a little back from what they've been paying out in past years. Corporate profits have been soaring in this recovery, mostly because corporations have taken more of the resulting profits than their workers. Corporate profits have been going up relative to wages. Now that started to change just lately. But it's not good for companies for that to happen, because that means they're paying their workers more than they're getting for the stuff they're selling, which
Wow.
means their margins contract in that kind of environment. So, Greg, the next chart that
Yeah.
you've got there
Hold on,
is
hold on.
okay.
I mean, just I know this is kind of low tech, but it's all I got.
Okay, it's the
Okay.
blue.
Oh, here we go. Yeah. Here we go. Let's go this full screen.
Yeah, that. So that shows corporate profit margins, and see that they rose nicely for most of the recovery, and then they plateaued in 2005. Corporate profits or corporate margins actually started to contract a little bit, and then the Trump tax cuts kicked in, and corporate profits jumped again. But that's a one-time thing. Now future comparisons are against that really good year in 2018. So what you got for corporations right now?
So you think the chart's going to, if it continues, it's going to go down.
It kind of has to, because that was a phenomenal year, and margins were already contracting starting in 2015 because wages were going up. So going forward, you're going to see negative comparisons on margins. In other words, a lot of companies are going to report down years for earnings in 2019, 2020. So the question is, can you have a continued equities bull market when equity prices are at record levels? That's the next chart that you got there.
Yeah,
Greg.
hold on a minute.
And corporate profits are declining. And intuitively, you want to say no to that, right?
Yeah, hold on. Let me give you your chart here. This is my favorite chart. Hold on. All right. So here is 1929. Bing. Okay. And if you just look straight over from 1929, yeah, that peak, that spike. Here we are. You are here. So that pretty much, shows. I scribbled on this. That's my right. So right here now. This is now. So we're basically right around where we were in the last really wackadoodle bolt up in crazy time stock prices, right?
Yeah. I mean, again, you can't make any ironclad predictions in this world. But if you're looking at history and you believe that history still has any meaning in this world, stock valuations are at a point where they're probably going to disappoint overall in the next decade. Historically, when they've been this expensive, you had a really bad decade in equities, and so you would think that that's probably going to happen just on valuation. So combine extremely high stock valuations with falling corporate earnings, or at least contracting corporate profit margins, and you've got a recipe for equities not being a great place to be.
And rising wages.
Yeah. Wage inflation is up. Corporate profits are down, equities are incredibly expensive. That's basically the story in 3 sentences. So again, this ties back into gold, because this is the story that our typical member of the 1% is going to hear from some of his business advisors, at least, when he's trying to decide what to do with his next $10 million. And that means equities may not be the smartest place for him to put that. In fact, you can make a case that you should be selling your stock portfolio to the retail investors that are getting in right at the end, and the central banks that might be buying stocks, and the corporations that are borrowing money to buy back their own stocks. In other words, the really dumb money will be the buyers in the future. You want to sell to those guys and go on to something else. So that's part of the gold story, because when you're doing that, you're raising money. You're not just looking at what you've got now to figure out how to invest that. You've got new money coming in that you got to do something with. So it makes precious metals look that much more interesting, and it makes stocks that much more volatile. There's a case for shorting stocks at this point. Historically, whenever they got anywhere near this price level, the guys who shorted stocks made fortunes. So it comes down again to whether history
risky.
Matters. Yeah,
that is risky. Buying gold and just holding it and saying, okay, long term, if I have 3, 4, 5, 10 years, it looks like this is going to go this way. All this debt, all this debt. The debt is stupendous.
Yeah, and we're not paying it off. See, that's the thing. We're not trying to fix our past mistakes. We're doubling down on this. Every big country is running deficits that are dramatically bigger than they were 5 years ago. In the U.S., we are back to $1 trillion a year deficits, which is Obama administration, post Great Recession kinds of numbers. And we're doing it 10 years into an expansion. So in the next recession, we'll have to, normally central bank or governments double their deficits from peak to trough when there's a recession. And if we double our deficits going forward, that means it's 2 trillion plus. So in other words, we're taking on huge amounts of new debt at an accelerating rate. So we are not fixing any of the mistakes that you and I have been talking about for the past 5 years or however long we've been talking. Which means the problems that are going to flow from today's mistakes are going to be that much bigger because we're compounding yesterday's mistakes. So what do you do? You know, but I gotta throw this caveat in though. There is a scenario, and we kind of talked about this earlier, in which U.S. equities go up, and that's the accelerating inflation scenario. You know, if we become Zimbabwe or Weimar Germany, then if you own stock in a company that has pricing power, in other words, that can raise its prices along with the general inflation level, you're protected. And that makes the big blue chip multinationals pretty good buys at any price. You stop caring about price levels in that kind of an environment. And that's, I'd say that's less likely of a scenario, but it's a scenario that's possible. So it makes shorting this market, which should be a no-brainer based on valuation, riskier than it would otherwise be because we've got these central banks behaving in such crazy ways. You know, it takes us back to what you were saying about Trump and the Fed, that we're behaving in ways that that for us in modern times represent uncharted territory and monetary experimentation, but aren't that out of the ordinary if you look backwards through financial history. Countries do this all the time. You know, they take on too many debts.
Not like this. No, this is
this is global. That's what's unique about this time. Is in the past, hyperinflation has happened one country at a time. When you know, Hungary or someplace borrowed too much money, printed too many dollars or too many of whatever the Hungarian currency was back then, and the value of that currency collapsed. But it happened in context of everybody else being on the gold standard and just chugging along as usual. This time, everybody is on a fiat currency, fractional reserve banking standard that allows them to basically increase the money supply exponentially forever until the value of these currencies start to fall. But as a global coordinated group of central banks, they have some tools to keep it going for a while longer than a single central bank in a single little country can do. So the real question is not, is this going to blow up? It's clearly going to blow up, but when? You know, how long will it take for us to figure out as a society that you don't want to hold the dollar or really any of these other fiat currencies? You want to get out of the whole concept of fiat currencies. And when a critical mass of people start doing that, then it's game over. But we need that realization to dawn first. And when that happens is really anybody's guess.
With all this debt, and this is the other thing, is that even if you have a small recession with the unbelievable, ginormous debt. I mean, I think we were in the pre-interview, I was talking about how, we were at, in 2008, 160, 65 trillion in global debt, and we blew it up to $250 trillion. I mean, we just exploded it. And does it take that big of a downturn, which is maybe what Trump is saying? Does it take that much for all this debt to go sour? I mean, he's talking about QE and bond buying and all this, and he's just absolutely, I mean, he went from a rate cut and QE at the same time right now, within a week's period. I mean, Kudlow, Kramer, and Donald Trump, so they must be freaking out about default in all these stores closing. I mean, everybody from Payless Shoes is closing a couple thousand stores, Victoria's Secrets. I mean, that whole industry, you think that would hold up, right? But man, everything is tanking. I mean, right? Does it take a big downturn for this thing to get out of control?
Well, it's possible that it doesn't. It's possible that a garden variety equities bear market that is sustained, that leads to a garden variety 1 year long recession would blow up the global financial system. See, wow. That's the stuff that they're hearing that is terrifying. And not everybody's saying that. You know, there are a lot of people on the left of the Keynesian spectrum who say, you know what, we can borrow as much money as we want to forever because we got a printing press. Just don't worry about it. Put everybody back to work, rebuild those bridges, invade any country you want to, and just pay for it with newly created dollars, and you'll be fine. There are guys saying that. But there are probably older, wiser people whispering in Trump's ear who are saying, you know what? The next equities bear market might be the end of the financial world for us. So to the extent that the guys in government right now are listening to the people who actually understand this stuff, in other words, the people who are saying be careful, they're so worried that they're willing to experiment with monetary policy again in order to prevent the crash that could make them this generation's Herbert Hoover. Whichever president is in office when this blows up is going to be in the history books for 100 years, is the person who presided over the second Great Depression or the second Great Hyperinflation, whatever the name they come up with for what's coming. You don't want to be there in charge when it happens. So that explains a little bit of the kind of panic that you hear from these guys. Stocks are at record levels. Unemployment is 4%, and the president is saying, no, we need to cut interest rates, and et cetera, et cetera. So it's an unusual piece of timing, to say the least, for that kind of stuff to be coming out of the White House. But, an election's coming up, and they want to err on the side of caution with the whole a bear market could blow up the financial system thing. And so when you see it that way, it's not that surprising. It's just ominous, because in previous cycles, we've waited till the recession started to manifest, then aggressively cut interest rates more and more each time. But now we're not even waiting. So we've taken the next step to where we're preemptively easing to prevent the next downturn. And that means you extend the expansion if it works, which means where does unemployment go? 2.1%? What does wage inflation do? What does it hit 5% or 10% before we have to step in and tighten? There's no way to know, but that's the trajectory of things now. So this is new and scary and fascinating. From a safe distance, this is going to be really interesting to watch. Unfortunately, most people won't be able to watch from a safe distance. They'll be right in the middle of the tornado.
The question then comes down to, what's cheap? What do I do? What's cheap?
Yeah. And see, it used to be cash, right? You used to stuff cash under your mattress. But if in this cycle we have to devalue cash in order to get through the next election cycle or the next corporate earnings cycle or whatever it is we're trying to get through, then cash under the mattress is a bad thing. People in Zimbabwe and Venezuela who had cash under the mattress now have a lot of toilet paper. Basically, they don't have, they don't have groceries, they don't have a house. All they've got is these worthless pieces of paper, and that's the risk this time around. If we succeed in generating higher inflation, then we succeed in screwing over the people who trusted the government by hoarding cash, and that complicates things for the average person, because I think the average person who doesn't spend their days obsessing over this stuff just figures, well, if I have a bunch of cash, I've got my emergency fund. I've got 6 months worth of cash stowed away, and I can get through whatever crisis the world is going to throw at me. But if your cash is at the center of the crisis, and then you lose your job, or then you get sick, or then your roof leaks, you've made a mistake, and you lose out. And I'm afraid that's going to happen to an awful lot of people.
John Rubino, dollarcollapse.com. You also have a sign up for emails. You have a free newsletter, free mail out. You write a lot. You're a prolific writer. Do you have, we'll put that at the end of the interview, your sign up, and of course, your website, dollarcollapse.com, which is fantastic. You write a lot of stuff, and you also aggregate a lot of great stuff, your top 10 videos. So thank you for putting me in there a couple of times. I appreciate that. But dollarcollapse.com, check in after the interview section for you people on YouTube, and you can sign up for a free newsletter, a free, for email subscription, and to get John's work sent out to you. Is that right?
That is, Greg. Yeah. You click on that, add your email, and you'll be on the list for all the depressing stuff I'm going to tell you going forward.
Well, it could be to be forewarned is to be forearmed.
Well, yeah. Actually, this isn't a depressing thing except for 90% of the story. It's actually an investment thesis, right?
Yeah.
So you look at what's happening, and if what's happening is bad, then you invest accordingly. And there are things that, in past crises, where most things went down and a handful of people got rich. So that's what we're going for this time around. We want to find the 2 or 3 things that, while everybody else is losing their shirts, makes you rich. And historically, there's always something like that. So crisis equals opportunity, and that's what we're looking for.
Okay, well, John Rubino, dollarcollapse.com. John, thanks for joining us today on USAWatchdog.com. You're a great guest. Thanks for coming on.
Thanks, Greg.